poll gives everybody a good way to a little extra time to join. But this is a very important poll to me, and so hopefully. Ah. So far, nobody thinks I'm super handsome. What's going on with that? Not a one. You know, my mom thinks I'm handsome. I don't know if you know that, but she does. Well, I live in Chicago, so at a minimum, I probably live far away from you. No, and all right. Well, we'll let this run for 2 more seconds, and then I'll turn it off. This is not something I'm going to go back and look at, so don't worry. I'm not going to be checking on who thought I was hilarious. But you know, it's a good way to. All right, we'll close the poll. It's just a good way to waste, you know, an extra minute or two to kind of get a feel for whether the audience, you know, whether people have a sense of humor. You have no idea how often I am and how poorly the presentations go when 95% of people pick he lives far away from me. So welcome. This is understanding the VIX and the VIX ETPs, which you know, is VXX and some of those other names. I am Mark Sebastian. I was a trader on the SIBO and the American Stock Exchange. I do consulting work and for hedge funds and registered investment advisories, different things like that, and kind of trade my own account as well. So I am an active trader, and I've been around the block at this point. Liz Clayman is wearing like 9-inch heels in this picture. I just want you guys to know. She's maybe, you know, I'm not huge. I'm like 5'9", but she's about 5'3" in real life. Really nice lady, though. Really nice. Super nice. So today what we're going to learn is what is the VIX, its intent, what makes VIX unique, how the VX futures trade, and that's the VIX futures, how the VIX ETNs work, and then I'm going to show you a little option trade that I like to do in VIX. So let's start. So the VIX is the CBOE Volatility Index. All right, that's what it stands for. The purpose of the index is to gauge the buying and selling of options in the S&P 500. I'm constantly having to correct people on TV because, you know, you get a guy, actually yesterday I was on Varney talking to Varney, actually, and name drop, and, you know, he said, well, the VIX really represents fear in the market. I said, no, it's really a gauge on the cost of insurance, how expensive it is to insure something. You know, just there are people that live in flood zones and right along the San Andreas Fault and all over the place. And, you know, they have also expensive insurance. Doesn't mean they're afraid of it. It just means that they, you know, it's not as cheap to insure their house. So if you think about VIX as if it's a form of purchasing car insurance. All right. Right now, the VIX is priced in the market like it is a 16-year-old driving an IROC Z Camaro who smokes Lucky Strike unfiltered and has a leather jacket and a switchblade in his pocket. You know, whereas as recently as May and June, the market was pricing it like it would price insurance for, you know, me or my wife, you know, married with children, aged, you know, 30 to 45. We are the cheapest people to insure, my wife especially. And so When there is more buying than selling, generally the market is trying to buy protection. So when the VIX is up, what the VIX is telling you is the market is trying to buy protection. And when there's more selling than buying, the VIX is telling, and the VIX is down, the VIX is telling you that there's more selling than buying. So VIX is up, the cost of insurance is higher, and vice versa. All right, similar to the S&P 500, this index is not traded. Many of you probably know this. There is no way to actually trade the S&P 500. All right, there are ways to trade similar vehicles to the S&P 500. The S&P futures track the SPX, like correlation is something like 99% or 99.5%. The SPY tracks the S&P at about 99%. One can trade baskets that track the S&P. So, one second. So that's really the key, is that there's no way to trade the actual SPX. Differences will come from the cost of execution, slippage, the fact that you can't trade fractional shares from a basket. Now, what makes the VIX even crazier is that there's no way to actually trade the cash VIX. So the VIX that is quoted on the screen all day, all right, that you see on CNBC or Fox or Bloomberg or, whatever you're looking at, all right, the VIX, there's no way to trade it, all right? The closest thing is called a variance swap, and those are only traded over the counter, and they are extremely complex to trade. And they involve the trading of thousands and thousands of contracts simultaneously. And you will imitate the VIX for that day, and then you'll have to rebalance the next day. The slippage and commission costs would put somebody out. Nobody has been able to figure out how to recreate this index. Believe you me, if somebody could, they would, and they'd make a killing. All right. The VIX is essentially an estimate of implied volatility on S&P 500 options, that's the SPX, that has a net constant duration of 30 days. All right. Constant duration means that it attempts to constantly mimic a portfolio with 30 days to expire. All right. So today, the settlement of VIX was what a option with 30 days to a basket of options with 30 days to expire, where they would price. Tomorrow, it will be what a basket of options with 30 days to expire would price. In 6 months, it will be what a basket of options with 30 days to expire on the SPX would be worth. All right, that is what the VIX measures. The weight of the VIX puts more emphasis on at-the-money options, those trading near the underlying. All right. Oh, low volume. All right. Here, I'll put that a little closer to me. Is that better? That's the first time anyone's ever accused me of having low volume. The weight of the VIX naturally puts it on at-the-money options. So, the S&P closed, 1960 today? So, or 1957, something like that. So that would be, the 1950s, the 1960s, around there. All right, and with 30 days to expire. The weighting of the VIX naturally puts more emphasis on out-of-the-money puts than out-of-the-money calls. All right, the VIX uses the 2 weekly options closest to 30 days to expiration. All right, so the calculation comes from weekly options. All right, one that is equal to or less than 30 days, and the other that is more than 30 days. So in this chart, these would be the 2 contracts used right here at the time I pulled this out. All right. So now what is the VIX? All right. The VIX is quoted as a price, but it is really a percentage. Volatility, despite not being spoken as a percent, is always a percent. All right. Just like, all the other things we quote, well, really, batting average is a percentage. Earn run average is a percentage. Things like that. All right. So if the VIX is 14, that represents 14% volatility. All right. So now what that is, that's 14% volatility on an annualized basis for the next 30 days is what the VIX is pricing when it's pricing 14%. All right. So I think the VIX settled 25.40 today. So it is saying that for the next 30 days, the VIX is pricing the market to move at 25.4% on an annualized basis. All right, now, if you follow baseball at all right, the Kansas City Royals just swept the last two teams, right? They swept the A's and the Orioles, right? The A's and the O's. And they're, one of the big things is going to be is batting average that a lot of people follow. Yeah, no, I'm excited. I'm a big George Brett fan. So ever since I was 4 when the Pine Tar incident happened, but when I read about it, I thought that was like the coolest thing I've ever heard. So when a player's batting average goes from 250 to 275, player goes on a hot streak. So as that batting average goes from 250 to 275. Have you ever heard, in the history of the game, have you ever heard of somebody saying, so-and-so's batting average is up 10%? No, they'll say 25 points. That's the way you should look at VIX. VIX matters in raw point movement, not in percentage terms. All right, percentage movements don't matter. So this is a graph of the VIX relative to a graph of the S&P 500 in terms of returns. All right, so I'm comparing the returns here, all right, over the last 2 years. All right, I think a better image, this is one of Russell Rhodes's graphs. He's my partner in crime in VIX education, is on the right. You've got on the red is the VIX, and on the right you can see VIX levels. And this is through the end of September. All right, so we just missed October. And on the left and the blue line is the S&P 500. And what do you notice? They're somewhat mirror each other. All right. So the VIX negatively correlates with the SPX. When the SPX is up, VIX is generally down. All right. When SPX is down, VIX is generally up. This makes sense as generally when the market sells off, volatility does increase. Look what's happened over the last couple of months or the last couple of weeks. Volatility has increased in the market. Now, there's also the issue of similar movement against a lower number. So yesterday, we'll use yesterday. All right, so yesterday the market ended up down 15, or let's just say 20 to make my math easier, okay? And when the S&P 500 was trading 2,000, that represented a 1% move. With the S&P trading, 1850, that represents a 1.1% move. So as the underlying price drops, volatility naturally increases because even if the movement stays the same, it is a greater volatility. And the same thing on a rally, right? As an underlying rallies, volatility will fall because, if the S&P is moving $10 a day when it's trading 1,000, that's 1% a day. If the S&P is trading $10 a day and it's trading 2,000, that's a 0.5% a day. Lower volatility. All right. Any questions on that? Those are two of the three reasons the VIX rallies on a sell-off and sells off on a rally. All right. Now, in addition, there is a couple of other important features of how the VIX is calculated that cause it to increase in a sell-off. And this is actually something you need to understand, all right, because one of the ways I use the VIX is kind of an indicator. I don't know, I do a lot of analysis of VIX to SPX. So the construction of the VIX naturally causes the VIX to rally when the market falls and then fall when the market rallies. It's caused by volatility skew. And what volatility skew is a representation of supply and demand in options. I mean, think about it. The entire world is long stock, right? You've got firms like CalPERS and all these pension funds and all these state pension funds who are like, if you're a short seller, you're evil. All right? Who here thinks short sellers are evil? I'm not seeing a lot of answers. Right. Not me. Nobody. Nobody that understands trading. All right? But the whole world is long. All right? That's why. All right? It's, it's the situation of, where their interests lie. All right? So because CalPERS owns all these stocks and whatever, naturally when they're hedging, they're buying puts because they've got risk to the downside. All right? To finance those puts, a lot of times they'll sell calls. It's called a collar. All right? What the collar does is create pressure, causing the underlying to rally here. All right, so volatility demand rises on the downside and gets pressured on upside. All right, so now if volatility doesn't move at all, right, remember at the money options get the most weighting. So if I'm here and then the underlying falls just down the curve, and we're still trading on this curve, but now at the money is here, VIX is going to read a lot higher. Okay? One thing I do when I'm trying to figure out how much volatility is actually moved is I pay attention to strike price implied volatility. So instead of just looking at the VIX, I'll look at, okay, where were the 1,800 calls trading in terms of volatility a week ago? All right, now where are they trading? All right, where was the 10 delta put in trading in terms of volatility, and where is it now? All right, so now what makes VIX so unique? All right, if I asked you what the average price of the S&P 500 is going to be over the next 10 years, what might you answer? You might say, I don't know, 3,000 or 5,000 or whatever, or 2,000. Who knows? All right. The answer is your guess is as good as mine. What is the 10 delta put? Good question. Save that one for the end. I will answer that. I'll answer that at the end. All right. All right. Now, if I ask you what the average price of the VIX is going to be over the next 10 years, what would you answer? Well, for the S&P, again, the answer, your guess is as good as mine. For the VIX, the average mean over the next 10 years will be right around 20%, plus or minus 1, within a point. All right, now how is that possible? Mean reversion. All right, volatility is mean reverting. This means that over time, it hovers around an average. All right, for the S&P, the mean volatility hovers around 20%. All right, now, I don't really like looking at the mean of the VIX for figuring out high or low. To me, 20% is high. All right, whether we're 30 or 15, 20% is high. All right, and the reason why is the VIX has, how many times, do you guys know how many times in its history the VIX has traded below 10? Take a guess. No, it's not 0. Close, though. It's had a total of 9 settlements below 10%. All right? So I want you to think for VIX, instead of 0 being its floor, 10% is its floor. So when your floor is 10% and your upside is as high as it wants to go, what does that create? It creates a skewness. It creates a skewed mean, right? It creates a mean that's wrong, right? When no one can get a 0. So think about a class where so imagine this. Imagine you have a teacher that grades everyone on the bell curve, but the lowest grade he'll give is a D instead of an F. Well, that's going to skew up the average grade, right? That's kind of how VIX mean works. So I really like looking at kind of the mode, the median mode, what trades the most, where is the mode. If you do a histogram of kind of occurrences, think of 17.5 is really your average VIX price, not 20. So if we're below 17.5, VIX is somewhat low. And really, in the, call it 15, we'll say 16 to 19, we're going to call that normal range. All right, 15, 13, 14, 12, 11, 10, low. All right, anywhere above 20, high. Okay. All right. So this presents some unique trading opportunities in VIX. So if one is inclined to trade the VIX futures. So when the VIX is above 17, it will eventually fall back. And when the VIX is below 17, it will eventually rally back. Having this knowledge is a powerful weapon. Now, the one thing to remember, it can take a long time to mean revert. But it's still an important lesson in terms of scaling and sizing and risk. All right, so now let's talk about the VIX futures. Now, one reason why people like the VIX futures is the tick size. All right, VIX futures represent 1,000 times the value of VIX at expiration, and they tick in nickels. Remind me that one at the end as well. All right. So it expires monthly. It's 1,000 times the value of the VIX, and it trades in nickel instruments. Thus, a 1 nickel tick is $50. Not bad, right? So they trade on the CBOE Futures Exchange. They expire monthly on the Wednesday that is 30 days prior to the next month's settlement. All right. VIX futures, and this is important, they are European. That means there is no early exercise of VIX futures. So if volatility mean reverts and volatility is extremely high or extremely low, and we have 30 days to expiration, what effect do you think that's going to have on a VIX futures tracking of VIX since it's European? What do you guys think? It's going to cause it to undercorrelate. So it won't move as much as the VIX. When the VIX is at real lows, it won't sell off as much. When the VIX is at real highs, it won't rally as much. All right, so for instance, you guys know where the VIX, I said the VIX closed at 2540, right? The October future expires next Wednesday. You guys know where it's settled? Any idea? Waiting for you to share. I'm just double checking I'm right. Oh, that's cool. Huh. It's settled 2075. 2520, excuse me. I missed the last tick. So the October future settled 20.75, and it only has 3 trading days left. They settle at 315, just like S&P futures. Question was, when do VIX futures settle? 315. They've got a big, what can throw off the VIX future settle. Anybody know what TAS is? TAS? $3:15 Central, 4:15 Eastern. I'm sorry. TAS stands for Trade at Settlement. So what guys will do is say, I want to buy 15,000 futures at settlement price. And then they will, then guys will say, I want to sell X number of futures at settlement. And they basically have to match up buys and sells to find that final price. So the print can be weird on settlement. Right, so somebody has, if there's 15,000 to buy for, at settle, and then there's only 5,000 to sell, well then what happens is they'll say, okay, there's 5,000 to sell at, automatically, where can we fill these other 10,000? And they actually have to go into the market makers and pull out enough to actually sell. They have to find all the limit orders that are at settlement. So someone could put in a TAS limit offer, and that's what creates that TAS settlement price. Does that make sense? Think about it as kind of an order. You know how they post NYSE order imbalances? Somewhat similar, not exactly the same. So they expire into cash based on a special opening rotation on the Wednesday morning that is that Thursday, or that is that 30 days prior to expiration. So the last trading day for VIX futures is a Tuesday. Settlement is a Wednesday. So it's very similar to S&P 500 future settle. All right, now, Contango. Contango is a market condition where back month futures are more expensive than front month futures. When VIX futures are in Contango, it represents that the market is more afraid of long-term market risk than the immediate. VIX cash is below the futures price. Long-term expectations are that the VIX is going to rise. Now, VIX is in Contango over 80% of the time. This is what it looks like. So what you have is this slide of futures to cash. So, and this is where the futures get interesting. If I sell a future, and this is, I believe, this is May. Oh, no, it's April. So if I sell an April future at 17, at expiration, it has to get to this 15% level that the VIX cash is trading. So there's actually a slide down. So believe it or not, the future has a decay to it. All right, so now, backwardation. That is a market condition where front month futures are more expensive than back month futures. When VIX futures are in backwardation, it represents that fear of volatility in the near term outweighs fear of volatility in the long term. So the VIX futures are trading below cash. The market believes that, and it's basically a bet the market believes volatility is going to fall. And this is what it looks like. This is September 2011. I'll show you what the curve looks like today. So this is what I was looking at. Oh, you know, the October future, I was looking at the no future. I'm sorry. So October settled 21.95 with the cash at 25.20. So it's got $3.20 to make up in 3 days. Anybody know where the market's best guess is of where things calm down? Yeah, December. So now this is the key, VIX decay. As time passes, traders using the VIX to hedge have to deal with the convergence of VIX futures to VIX cash. All right. In Contango, it is a massive drag on a portfolio. In backwardation, this will actually pull the tailwind behind a futures contract. All right. So Contango to backwardation ratio, the problem is like 4 or 5 to 1. So they're almost always in Contango. What we're going through right now is extremely rare. Not extremely rare, but it's rare, let's say. Extremely rare is probably over the top. Maybe a little hyperbole there. All right. Less hyperbole than like LeBron James, the greatest basketball player of all time. We all know that's Michael Jordan. But still some hyperbole there. As trading in the VIX futures have become more and more actively traded, each of the ETNs, the ETNs have become a huge deal. Now, they each have a stated purpose. However, due to term structure of the VIX futures, many of the ETNs have some unintended consequences. All right, so now let's look at VXX. All right, the VXX, or the iPath S&P 500 short-term futures, ETN, tries to replicate a long VIX future with a constant duration of 30 days, right? Makes sense, right? The VIX has a constant duration of 30 days. Why wouldn't I want a future with a constant duration of 30 days? Makes sense, right? All right. Now, the intent of the fund is to allow traders to get long or short near-dated volatility. All right. The fund does this by constantly rolling out of front month futures and into the second month future. All right. Do we all know do you guys know who Sisyphus was? It's not just something my brother would call me after he punched me in the arm. All right, so Sisyphus, yeah, he was a Greek myth. So basically, he thought he was smarter than Zeus, tricked somebody into basically letting himself live forever. But she already got her snack. So what Zeus did was Zeus basically had him roll a rock up a hill every day, and right as he was about to get to the top, at which point his task would be done, the rock would roll back down the hill. It is to represent futility and permanent failure and a pointless, interminable task. And this is really the effect of VXX and UVXY for that matter. Now, contango and backwardation. All right. In a contango state, the VXX is constantly buying futures, writing them down to cash, only to sell at the bottom level and buy a new future further out. All right, this creates a major problem for this ETN because it is constantly selling a less expensive future and buying a more expensive future. The ETN has a limited amount of funds. When VIX futures are in contango, the funds are being depleted. So the VXX has recently had a huge rally from 28 bucks to about $40 a share or per ETN. All right. So in that time, all right, what effect do you think that has had on the return since inception of 44? Wow. The return since inception on the fund. What do you guys think? What do you guys know what the initial price of VXX was, split adjusted? Everybody take a guess. What do you think the initial, without cheating? All right. Everybody take a guess at what the initial price of VXX was at inception. Split adjusted. I'm seeing 1,000. I'm seeing 2,000. I'll show you this. The initial price of VXX listed, its initial list price, split adjusted, is $6,400. So it has this huge VIX move has caused VXX to return since inception an additional 0.002%. So when it's in contango, it can make sense to own VXX, to use VXX as a long hedging vehicle. Or now, excuse me, when we're backward, it can make sense to use VXX as a hedging vehicle. It is not a buy and hold vehicle. You cannot own it for more than a day when it's in contango. Intraday, it does what it says it does. Intraday, it will move with VIX. However, carry it for more than a couple days and you will be just ruined by contango. And, this is so if you ran a business that bought the product for $16.10 and sold it at $15.50, how would your company do? Well, and this is actually pre another split. I have to update that chart. So the VXX is rolling itself towards zero and should not be held for more than a few hours if futures are in contango. In backwardation, you have a lot fewer problems. In fact, it can potentially outperform VIX. VXX is a good volatility day trading product. In fact, typically movement in VXX will lead movement in SPY. VIX futures almost always lead movement in the S&P 500 futures. And this is no knock on S&P 500 futures traders, but VIX traders are much, 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 much smarter because you have to be. All right. So I don't mind using VXX as a hedge against falling volatility. All right. But it's a terrible hedge against rising volatility. All right. So here's some different products with similar or worse results. All right. VXZ is the midterm. It's months 4 through 7. And it's bad, but it's not as bad. All right. UVXY is the double long, so it's levered. So in fact, it actually is worse, more than doubly as bad as UVXY. TVIX, much the same. Here, let's pull up a long-term chart of TVIX. I think you guys will like this one. I think TVIX might be worse. Yeah, the adjusted price, list price for TVIX is 8,000. UVXY, the split adjusted price is $9,223. You guys noticing a pattern here? Now, XVZ, this is an interesting one. Of the kind of trying to be a long ETN, this probably does the best job. All right. I don't believe it has any splits. Let me double check. It also has the least volume, of course. It's the one that works best. Why would anyone trade it? See, I don't think it has a reverse split in it. It does not. See? Here's one where it's only off, it's off less than 50%, and that's through a massive short volatility period. So now let's talk about the inverse ETNs. The inverse ETNs are theoretically going to infinity, but they have daily tracking issues. So that's the one problem. So they underperform being short the underlying, but they can be held in an IRA or things like that. So you've got XIV, which is the inverse of VXX. You have ZIV, which is the reverse of VXZ. And then you've got SVXY, which is similar to XIV, but it has options. All right, so now I'm going to show you a little trade that I like to do when volatility gets a little bit of pop, not quite like this. I wrote this kind of at the beginning, at the end of September, so I need to update this into a different trade probably. So one thing to understand about VIX, and we talked about that, is that 10 is the lower bound, right? So it can go high, but it really can't get that low. So what it makes is bear 1x2 start to look really interesting. So I did this trade kind of in the October future, but I did it toward the end of September when the VIX was around 14.5. And my belief was that the VIX was going to fall to about in between 13 and 13.5. So what I did was I bought 10 of the VIX 13.5 puts for 55 cents. I then sold the 20 of the 13 puts at 35 cents. Net, I bought that 1x2 for a 15-cent credit. And so people say, well, Mark, why do you like this better than just selling the 12.5 put? And I'll tell you why. All right, above 13.5, I've got my keep the credit zone. So I'm going to keep my 15 bucks. All right. And then, in between there, I've got this really great profit zone where I can potentially do extremely well relative to my risk adjusted. This is a great trade. All right. And if the VIX really starts to break 12, I can manage this risk in here relatively easily. Because the VIX ain't going to be coming from kind of this range over in here down to 12 quickly. All right. So this is obviously full of nuances, but the key is to have the lower bound of the trade makes the trade more favorable than a standard risk graph would calculate. All right. This is why somebody who is a slave to a risk graph, there's some people out there. You don't fully understand what you're looking at. All right. Now I cover this trade a bunch in a little course I'm going to offer you. So I want to thank you for attending. On October 4th, I did, myself and Andrew is my chief operating officer, we taught a 3-hour class on a Saturday in 2 pieces. Andrew covered kind of understanding the zones where VIX will trade, and then did a huge amount of coverage on the VIX ETNs, so how to trade options and the ETNs themselves in VIX and SVXY and UVXY, things like that. Then I went in and I dug into the VIX options in heavy detail for another hour and 45 minutes or so, hour and a half, hour and 45 minutes. It's a pretty great course, and you can find it at optionpit.com/VIX Primer. Now, we normally sell these courses at $147. Because it's a replay, I'm going to sell it to you guys at $27. All right, so about the same price as my book, The Option Trader's Hedge Fund. And instead, you get to listen to me talk. And, I'm sure by now you guys are in love with that concept, right? Kidding. All right, so what questions do we have? All right, so the first one that I promised I'd get back to is, all right, what is a 10 delta put? Delta is how we measure how far away from at the money something is, or it can be a measure of how an option is going to correlate. So a 10 delta put will move 10 cents in the opposite direction of the underlying. All right, it's negatively correlated by 0.1. So if I own a put and the underlying rallies $1 and I have a 10 delta put, I will lose 10 cents. If I own a 10 delta put and the underlying rallies or falls $1, all right, I will make 10 cents. That is what a 10 delta put is. Now, the second question I saw involved the interest rates environment. Now, back in the 70s, would the VIX have been, what would the VIX have been with inflation? Any importance of interest rate to VIX in context? Well, no, because VIX is really about volatility, all right? And one of the weird things about the 70s was that despite the high interest rates, stocks really didn't move around that much. It was a low vol bear market. Vol leading into kind of the 70s was just crazy low. All right, so it's really the volatility associated with the stock market. Do you like the use of risk reversals in VIX options? Is that covered in your class? Are there a lot of strategies in your VIX class? There are a ton of strategies in my VIX class. All right, and do I like risk reversals? And you mean selling a put and buying a call in order to get long vol? I think that can make sense. I typically like selling a put and buying a call spread because of the use because of kurtosis and VIX. Also, have you seen Larry Williams' VIX fix, which just looks at price and duplicates VIX without premium? Any observations? I have not seen it. And there's really no way to fully duplicate it without some premium there, one way or the other. Any other questions, comments, thoughts? I will be pushing the recording out probably tomorrow sometime. And actually, if you go to the page, I've got an old recording that I did already up there. So I'll probably replace it with this recording. But you can see that recording on the page right now if you're saying, oh my gosh, that was the best presentation I've ever seen in my life. I've got to see Mark present again. All right, well, it's already there. And if that's the way you feel, please let me know. I'm all about it. How long will the offer be open and the link? I'm going to leave that offer open probably for another couple of days. I am giving a free presentation next Thursday, the 23rd, on using volatility to trade direction. And then also on November 8th, we're going to do another Saturday class on directional trading of using options for directional trading. So you can go to our events page to check that stuff out as well. Yeah, you're welcome. Thank you very much, guys. All right, everybody. I hope you have a great evening. And yeah, I love George Brent. Oh, what do you expect to do in VIX and NOV? I think it's going to back off at some point. At some point. I think we're going to have to retest that 1800 level that we tested on that big sell-off. We had that big 10% drop. And, we actually touched, like, to the penny, down 10% from the closing high of the S&P, and then bounced like a trampoline. And so I think we'll retest those, probably hit that 1700 level, and then higher. All right, and go Royals. Everybody have a great evening, and thank you for attending.